Big tech absolutely crushed earnings, but only one stock is a strong buy. So in this video, I'm going to rank Apple, Microsoft, Meta, Google, and Amazon from worst to best based on their latest earnings report. Without wasting your time, let's get straight into it. The first company is Apple. Apple finally is reaccelerating the revenue growth. Big part of 2022-2023, Apple was almost not growing on the top line. But recently you can see the growth was reaccelerated to 20% for Apple. And what is even more important is that Greater China revenue is also reaccelerating. From declining, China revenue currently is growing 18% in the latest 12 months. High margin services revenue reaccelerated to 16.3% in the latest quarter, which is absolute record for the last 3 years for Apple. Tim Cook recently announced that he will be stepping down from Apple CEO and John Tornos will become CEO from September 1, 2026. We did not have a clear strategy from the new CEO of Apple, but based on a guy is current hardware chief, I believe Apple understands that their advantage is their custom silicon and they will be betting big on that in the future. Unlike to other Magnificent 7 players, Apple is not investing heavily into the capex. In 2016, their capex was $12 billion. Fast forward to 2025, the capex is still $12 billion. All other Magnificent 7, Microsoft, Amazon, Google, and Meta are heavily investing into the capex. They are building their models, they are building capacity, they are trying to innovate. Meanwhile, Apple is kind of ignoring all this AI revolution, and most of the free cash flow they are just using to buy back stock and also pay dividends. In the latest quarter, they generated $26 billion in free cash flow, bought back $12 billion of stock, and paid $4 billion in quarterly dividends. And during latest earnings report, they announced another $100 billion in stock buybacks. I understand that Apple has strong ecosystem, but 35 price to earnings and 33 price to free cash flow, I believe is a little bit expensive for Apple. And when I try to model the return for Apple, where revenue will reaccelerate to 9% until 2030, with net income margin expanding to 30% and price to earnings of just 25, I actually get only 9% return for the next 5 years, which is significantly underperforming the market. So if you're long Apple, you believe in significant reaccelerating in revenue or improving profitability, for me 10% in 5 years is relatively low performance, and also I don't really like that Apple is not participating in the AI revolution, so for me Apple is D tier. The next company is Microsoft. Microsoft Azure keep reaccelerating, and in the latest quarter the growth is north of 30%. Absolutely nice to see. The bear case I see in Twitter is that total remaining performance obligations did not grow quarter over quarter. 631 billion in December and 633 billion in March. Meanwhile, for Amazon and Google, RPO grew significantly in the latest quarter. We need to watch this metric closely in next quarters, but I don't think this is too bearish because they already have north of 600 billion in RPO, which is already too much. Another bearish point about Microsoft is that they are not innovating fast enough. Anthropic already implemented their Claude into Excel, PowerPoint, Word, and other Microsoft software. Meanwhile, I see many complaints in X about Microsoft Copilot. Microsoft is down year to date, and I see this valuation as a track. 10-year average for Microsoft is 32. Meanwhile, Microsoft is trading for the price to earnings less than 25, and for the price to operating cash flow also trading under 10 years average. When I model Microsoft's return with 12% growth over the next 5 years, 35% net income margin, and 26 price to earnings, I get 60% return on investment on the shares if we buy Microsoft today, or 9% CAGR, which is market beating returns for this huge compounder. I think Microsoft is a great company. They have strong moat. I have some concerns about innovation. I have some concerns about the dependence on OpenAI IPO. Later this year, valuation is currently very attractive, but I will rank Microsoft as a S tier for now. The next company is Meta Platforms. Meta Platforms grew revenue 33%, absolutely mind-blowing revenue acceleration for this advertising juggernaut. The family daily active people declined quarter over quarter from 3.58 trillion to 3.56 trillion. Meta explained the decline, which is due to internet disruptions in Israel and also WhatsApp restrictions in Russia. But investors should watch this KPI metric to see if this decline will continue, or this is one time and later daily active people will continue to grow for Meta Platforms. Meta is investing in capex huge amount of money, even though they are not hyperscaler, but capex grew significantly from just $1 billion per quarter they were investing in 2016, and currently In average per quarter, they're investing north of $15 to $20 billion in capex. This is just mind-blowing amount for capex for advertising company. But Zuckerberg is trying to take advantage of this opportunity, and he's trying to build a model. He's trying to improve the recommendation algorithm. He knows that in the future 90% of content will be generated by AI, and he needs to prepare the company for this future. The valuation for Meta platforms currently seems reasonable at 22 price to earnings, but meanwhile, when we remember that the company is still growing 30%, more than 30% on the top line, probably 22 price to earnings is relatively cheap for Meta platforms. And based on the price to operating cash flow, which is the best metric for the company investing in capex, Meta is currently trading at 12, under 17 10 years average. Modeling the ROI for Meta platforms with revenue deceleration to 15% in 2030, net income margin of 30%, and PE of 25, which looks very reasonable for this kind of growth on top line and profitability, I see 132% return for Meta platforms or 18% CAGR, which is very attractive return for mega cap company like Meta platforms with founder-led, very hungry Zuckerberg who is still very young and who will lead company to the new highs. I will rank Meta platforms at B tier. We are not sure about return on investment on capex. We are not sure about the new model of Meta platforms, but I believe the distribution which Meta has could not be matched by other companies. They have 3.5 billion eyes in front of their applications all day long. So I believe the opportunity is there for them. Now they need to invest and take advantage of this opportunity, take advantage of this huge user base. The next company is advertising juggernaut Alphabet. Google reported earnings and the search continue reaccelerating to mind-blowing 19% year over year. This is absolutely unbelievable after all those talks few years ago that search is dying. Currently search continue reaccelerating, and if I show you search growth annually, you can see 7.7% in December 23 and then 13%, and currently 15% for Google search. Absolutely, for this kind of base, $234 billion. But this is not even the best part. The best part is that Google Cloud reaccelerated to 63% and outperformed both AWS and Microsoft Azure. The Wall Street is not punishing Google for huge capex because they see the return on investment. Google Cloud operating margin is improving. Google is still printing huge amount of free cash flow. So unlike Meta and Microsoft, where Wall Street punished the stock after this huge capex, Google is being rewarded and the stock is trading close to 52-week high. Even with huge investment, Google still printed $18 billion, almost $19 billion in free cash flow, bought back $15 billion of stock, and paid $2.4 billion in quarterly dividends. Looking at valuation for Alphabet, currently trading at 32 price to earnings, and let's see in a history where last time Google traded at this kind of PE. Checking in a history, and actually Google was traded at this PE in 2008. The last time Google traded at this valuation was 2008. The company is firing on all cylinders, but the valuation currently is a bit overstretched for Google. I have a huge position in Google. Actually, Google is my second position. I'm not selling Google here. I'm holding my shares, but I sold September covered calls for $420 per share for Google. And you will see why when we are doing the projection, modeling 12% revenue growth for the top line, operating free cash flow margin of 35%, and multiple of 22, we get just 4% upside for Google, which means the Google valuation currently is a little bit on a higher side. Will there be a correction? I'm not sure about that, but what I know is currently Google is innovating, and all those spreadsheet or projections could not work in this case because some stuff we just don't know. What if they're opening new segments of the business, like with their TPUs? Currently they're going to sell to other companies. What if the Venmo is going public with a huge valuation? What if the SpaceX is going public and they currently owns 15% of SpaceX? So I think Google has call options, but I believe the valuation is a little bit stretched for the company. So I sold covered calls to generate additional income for my big position in Google. Even though the valuation currently looks stretched, I will rank Google as A tier. For the long term, I believe Google is just a juggernaut, and we have only one company left, Amazon. Amazon's AWS reaccelerated to 28% in the latest quarter after growing just 16%, 17% here. Now we reaccelerated to 28%. And you tell me in the next quarter you believe revenue will continue to reaccelerating or the growth will plateau. I'm almost 100% sure that AWS will keep reaccelerating, maybe north of 30% in the next quarter. I've been investing in Amazon for a long time, and one of my strongest bull case was about operating margins, about robotics and efficiency improvements, about AWS and advertising is taking more part of AWS's revenue, and Amazon keep executing on the thesis. In the last 10 years, operating margins improved from 2% to almost 14% in the latest yearly report. Amazon has biggest capex among Max 7, and here what Andy Jassy told to James Cramer during the latest interview on the Mad Money on the investment and AI opportunity ahead.
When you spend $200 billion and you actually believe it's going to pay off.
Yeah, well, I mean, to me, the really big capital expenditure bet that we're making is because we believe that AI is the biggest technology transformation in our lifetimes. It's going to reinvent every single customer experience we know, and altogether new ones we never imagined. And if you look at the pace that things are growing, I mean, I used in the letter the example of after the first 3 years of AWS, we thought we were growing really fast, and we were about $56 million in revenue. And after the first 3 years of this inflection of AI, or this incarnation of AI, our run rate's over $15 billion, 260 times what it was the first 3 years of AWS. And we thought we were growing fast with AWS. So when you have shifts that are this momentous, you want to make sure that you invest in such a way that you can pursue the opportunity as broadly for your customers as possible, as well as for, I think not just our customers will benefit, but our shareholders and the company as a whole will be a very different company 5 to 10 years from now because we're betting big like this than it would otherwise be if we were conservative.
The valuation for Amazon looks reasonable with price to operating cash flow of less than 20 and 10 years medium is 25. So currently, even though Amazon is trading close to 52-week high, the valuation is still undervalued for this company. And projecting the return on investment for Amazon with 12% revenue growth, operating cash flow margin expanding to 25% due to the robotics, advertising, AWS, and price to operating cash flow of 20, which is still less than 10 years average, we are getting 113% return on Amazon for the next 5 years. I'm ranking Amazon as a S tier. I believe this is the beast of a company. This is the top 1 position in my portfolio. I have equity. I have $300 calls for January 2027. I'm very bullish on the company and continue holding this for the long term. Let me know in the comments if you would run companies in different order. Thank you so much for watching, and I will see you in the next one.